for Global Perspective. He is Chief Investment Officer, Chief Executive, PIMCO, Mohamed El-Erian. Dr. El-Erian, good morning.
Good morning, Tom.
We see another good data point there. What a mixed picture. Some days good data. We see futures advancing here off of Case-Shiller. The worries, the angst that so many of our listeners have, should we, at the margin, push those worries aside and look at these optimistic statistics, or are they backward-looking?
You know, Tom, all this speaks to what Ben Bernanke coined last week as the unusually uncertain outlook. Whether you look at the data, which is pointing in all sorts of directions, whether you look at the earnings, what we're getting right now is very, very noisy picture, and it points to an uncertain outlook. Now, there's two ways to think about this. One is, as you mentioned, certain data are backward-looking, others are forward-looking. The other way to think about it is the reality that during regime shifts, data gets very noisy because you're shifting from one regime to another. And our inclination is the latter. Our inclination is to think of this as natural for a regime shift. And we're moving from a regime of high growth, leveraging debt and credit entitlement to a more delevered, slower growing, higher unemployment world.
Mohamed, my colleague Simon Kennedy in London calls it South-South trade. Are you seeing in Brazil and in the Southern Hemisphere countries, these commodity-based emerging markets, are we beginning to see them feed on themselves and generate demand off themselves rather than the original colonial nations?
Yes, Tom, we're seeing them rely more on domestic demand and on regional demand, and that speaks to the fact, and I would call it a fact, that countries like Brazil are in a developmental breakout phase. They're able to sustain high growth, wealth accumulation, and greater resilience to external shock. It's pretty impressive what's going on in some of these countries.
When you see these countries, we worry about best practices of law and of contract and of financial systems. Do you see improving and deeper financial systems to go along with the prosperity?
You do. It's a development process, so it takes time.
Yeah.
And you're seeing a maturation of institutions, both in the private and public sector. So in the public sector, you're seeing much more fiscal responsibility, more respect for the rule of law. It's not perfect, but it's making progress. And on the private sector side, you're starting to see Brazilian companies becoming big multilaterals and being able to compete on the global stage.
One of our stories this morning, Mohamed, is that high-yield, high-risk bonds, junk bonds, are rallying by the most in 4 months. Do we want to go ahead and take this as a sign that risk aversion is off and people are desperate for yield after all this time?
Yeah, you know, the market will always look for return. The market will worry mostly about the return on capital rather than the return off capital. So the minute someone puts out a green light and earnings constituted the green light, you'll see people rushing back into risk markets, be it the equity market or the high yield market. And the issue, Ken, is will it be sustained? And for that to be sustained, we need continued improvement in data and continued improvement in top-line revenue.
And are we going to get that?
I think it's uncertain. The indicators we look at, and I know there's disagreement on this, but the indicators that we look at suggest that the economy continues to lose momentum. So we are more worried than some of the other people you've had on your show recently.
Well, there's a mix here. Mohamed, I see the Spanish spreads come in. You see Spain minus the German 10-year spread come in. I mean, it's essentially all success on the stress test. Do you signal all clear for Europe?
You know, the stress tests were important. This is typical Ekoloff, Stiglitz, Spence issues that you had massive information failures.
Yeah.
People weren't sure what was going on. They couldn't differentiate between the good and the bad. And what the stress test did, importantly, is they disseminated information to markets and to the public.
But what would you like to see more? This is absolutely critical. If you, and off of Stiglitz, Nobel laureate effort, folks, on information, what new information does PIMCO need to see to have confidence in purchasing Greece or Spanish paper?
Couple of things. One, at the level of banks, is the what next. Will banks then move to enhance their capital, in some case merge and strengthen? And then more generally, let's not forget that Europe is not about banks. Europe is about sovereign risk and about the inability to sustain high growth. So unlike the U.S. a year ago, when the problems was in the banks and governments had room in their balance sheet to support the banks, Europe, the problem is not in the banks. The primary problem is sovereign balance sheet and the ability to grow, the economic model. So we need more evidence that these countries are going to be able to reconcile fiscal sustainability with high growth.
Well, you were talking about things slowing down, but, so far today we've heard, earnings that beat expectations by, just to pick three names out of a hat, DuPont and Kansas City Southern and Lincoln Electric, which makes welding gear. Is the second quarter going to be the strongest earnings growth we see this year?
We may well can. And it's important to remember, earnings are backward-looking. So what we're capturing is the impact of the stimulus, the impact of the inventory cycle. There was a wealth effect from the first quarter. So the critical thing is the forward-looking indicators. And the indicators we look at, and this is not, an exact science. This is judgment. This is analysis. The indicators we look at suggest that the economy continues to lose momentum. And the key issue is going to be, ultimately, is this economy creating enough jobs to make people feel comfortable, to enable companies to invest? That's going to be a key issue.
When you look at this, folks, if you're just joining us and with us for the rest of the half hour, Mohamed El-Erian of PIMCO. I like what you say there about earnings being backward-looking, and we just heard this from Douglas Cliggott of Credit Suisse. How should our listeners position themselves if they're seeing a media frenzy of good earnings and good this and good that? How does PIMCO suggest, particularly with your new equity initiative, how do we position ourselves?
I think everybody has to ask two questions. The question that we like asking, Tom, which is, how much are we likely to make on our investments? But the second question is, in this uncertain world, or this unusually uncertain world, to use the Bernanke phrase, can I afford my mistakes? Right. And we have to acknowledge that there's lots of known unknowns. So it's important for investors to ask both questions. This sort of rally allows investors the opportunity to reposition themselves. And this is important. People forget that markets give you many, many opportunities to reposition yourself. They do not behave in a linear fashion. The behavioral finance people will explain in detail why that is the case. Mm-hmm. So I think that investors have to ask the questions, am I comfortable with the portfolio I have, given that the outlook is still for volatility and uncertainty?
Dr. El-Erian, is the best way to play the El-Erian space direct ownership of foreign securities, or can you get away now with the crutch of buying U.S. multinationals?
Both, Tom. In some cases, you want to own directly. In fact, the best trade in emerging markets right now, and it's a hard one to do, is to complete markets. Think of the mortgage market in Brazil. Think of the corporate bond market in Asia. That is the best trade, but to do that, you need private vehicles, and not many people can access these private vehicles. So second and third best are going either into the liquid public markets directly, or doing it through multilaterals. But the key issue, Tom, and that's important in your question, is to recognize that we are in a multi-speed world, that certain countries are both able and willing to grow rapidly. Others are still going through a deleveraging that's going to take a couple of years, and investors have to recognize this multi-speed world in their portfolios.
We were talking earlier about Fed Chairman Ben Bernanke saying the economy is unusually uncertain. Isn't that kind of an unusual thing for a Fed chairman to say?
It is, and I think it's an honest thing for him to say. He could have said uncertain, but he went one step further and said unusually uncertain. And I think that's right. I think that paradigms are changes. We have lots of structural issues going on. Just think the extent to which unemployment has surprised on the upside. Just think the extent to which policy effectiveness has surprised on the downside. We would have expected a lot more oomph for the amount of stimulus that has been put into this economy. And I think he's just acknowledging that it is an unusually uncertain time.
We've only got 1 minute left, and your multi-speed world sounds like the next El-Erian op-ed piece we'll be reading here in a couple days. If it's a multi-speed world and our American listeners are worried about American decline, can the sheer inertial force of a $14 trillion economy keep us away from American decline?
Yeah, that plus the fact that the U.S. is still the only provider of these global public goods. The dollar as a reserve currency, the deepest, most predictable financial markets. So the U.S. has lots of structural advantages. So, we're not talking here about an overnight decline, but we're talking about a need for the U.S. to confront its structural issues and to take advantage of its position rather than allow these advantages to erode.
Never enough time. Mohamed El-Erian, get some sleep. Thank you so much for being on today. He is Chief Investment Officer at Pacific Investment Management, a company